Today we're discussing the case study of a Swiss-based real estate investor moving to the UK. I'm joined by my two guests, Matthew Barrett from Bellecapital and Lisa Cornwell from PwC here in Zurich. Welcome to you both.
Hi, David.
Hi, David.
So we're going to tee up the scenario in just a moment, but before we do that, I'd like to come to my two guests for a short introduction, starting with you, Matthew.
Hello, my name is Matthew Barrett. I'm a senior relationship manager for Bellecapital based in Zurich. We're a wealth manager and I look after UK connected clients.
And Lisa.
I'm Lisa Cornwell. I'm a partner with PwC here in Switzerland, and I lead our private business, so anything to do with families, individuals and family offices on the tax and other issues, but never the investments.
Fantastic. We'll just tee up our scenario right now. So we have here the case of Francine, who has lived in Switzerland for 8 years after moving there from France. She is 55 and is married with 2 children. Her eldest child is going to the UK to study, and they've decided to move there under the new FIG regime. Francine's family owns a vineyard in France valued at 8 million euros. She works in property and runs her own property business. She doesn't know what the property business would be worth if sold, but has no plans to do so. She owns property in Europe worth approximately 15 million euros and has liquid portfolios worth 7 million euros. She has no structures in place apart from a business holding company. So, Lisa, just coming to you first, on the FIG regime, tell us a little bit about that and what the impact is for a potential move into the UK.
So there's always 2 things when we're looking at somebody relocating, and there's the immigration piece of how do you move into the country, and then there's the tax piece. And so for this one, the immigration, we'd need to make sure there was a viable route for her to come in. There used to be the investment visa. We hear that it will be replaced, but right now there isn't. So that would be the first question, is how do we actually get you into the UK? And then when it comes to the FIG regime, so we're now in the new world. We don't have the famous old res non dom rules anymore, with kind of some brackets around older res non doms. The FIG regime, I think, is actually quite an interesting regime, but it's very short. So for the first 4 years that you're UK resident, you can benefit from this regime. FIG meaning that your foreign income and gains will be exempt from UK taxation. So I think that's quite an interesting opportunity for someone coming in if they, want to rebase. For Francine, she's looking at coming along with her child who's coming in to study. So I think it's a nice time to come in because they won't have to worry about the tax. They will have to report it on their tax return though. So that's a bit different to before. Under the old rules, you just didn't report your non-UK stuff. Now, anything that's foreign, we will have to put it on a return. There's a lot more disclosure. So I think that's something that you have to feel comfortable with. And obviously keep a close eye on when the 4 years are up, because you then switch immediately into UK tax on everything. So those first 4 years though, as long as you're structured so that you've got your foreign income and gains, you're only going to be paying tax on anything that's in the UK. I think with Francine as well, a big issue that we would be looking at is she's got her European holding company and all of the businesses outside the UK. How do they actually work? What's Francine's role in those businesses? Because if she's in the UK and running things in the UK tax authorities are very sophisticated and they really understand if you're the owner and the manager of a business and you go into a country, you're probably going to carry on doing those things in that country. So that would be a question they would be asking is, are your non-UK assets still really non-UK or are you bringing them into the UK because of your activity in the UK?
So it's not the case of an offshore company somewhere, and depending on the substance of the relationship and how she's actually living her life and working, running the company, it'll have implications.
Exactly. And I think this was something that's a very common misconception for a long time was, well, if I've got my assets held outside of the UK, then I don't need to worry about them if I come into another country. But we're in the days of super transparency. Tax authorities are using AI more and more. It's very easy to figure out what's where and who's doing what in relation to which entity. So it's really important to make sure that piece is nailed down first.
And an opportune moment probably to look at the broader succession planning as well, because this move is a substantial move, isn't it? Looking at the affairs, we know that she's got these corporate holdings, but there could be, you'd need to look at the broader wealth plan as well. Although the 4 years is a short window, it might offer opportunity. Absolutely.
And I think, who wouldn't like to have a family vineyard, right? Yes. So we assume that that's going to be something that carries on. The other interesting piece about going into the UK is she won't be in the UK inheritance tax net either. So those first 4 years really do offer some good opportunities for restructuring without triggering a tax in the UK. We would want to make sure she was out of Switzerland, but you deregister, we presume she leaves her
on that
home.
point, I mean, managing the Swiss exit, what would you say, how does she make sure she does that in a clean way?
I think with Switzerland, it's probably a little bit more easy to demonstrate when you're leaving, if you're really leaving, because you go to the local authorities and you deregister. So you have a day that you have left the country. And if I assume in this case, maybe they aren't going to keep a property here, you don't have a home here anymore. So everything about your life has moved and you've formally registered with the authorities to say you're out. We'd also want to look obviously on the flip side, when do the UK think you're coming into the UK? Do you get split tax year treatment? So ordinarily you'll be tax resident for a full tax year if you meet the statutory residence test. But there are certain circumstances that apply automatically, that if you meet those, then we split the tax year. So we just want to make sure we understood when has she left here? And like I said, I think that's a bit more straightforward. And then when does she actually get into the UK?
And just looking at the vineyard, French located asset, UK resident owner now, what would the implications be for how she should look at that in respect of being UK resident with an asset like that?
Yeah, I mean, I think with a vineyard or any of that kind of business where we presume she probably has a team on the ground, what we would be expecting is that when she's travelling to the vineyard to undertake activity, and probably what she's doing in the UK is not likely to be managing and controlling that asset. But we would need to understand, what does she actually do? Is it a passive ownership and they have a board meeting once a year? So go to France and have your board meeting, tick. Or is it much more, she's getting sent bottles of wine in the post and drinking them? So we'd want to understand kind of on that spectrum what's happening and where it's happening.
Fantastic. And Matthew, just to bring you in, I mean, we've heard there about the tax side. We've heard about the potential benefits of this new FIG regime. What kind of implication would that have for you on the portfolio management side?
Well, the portfolio is a nice size. I think you said it was 7 million.
Yeah, 7 million euros. Yeah.
So, I mean, at 5% per annum, that's 350,000. The first question is that enough to live on when you're in the UK? With all the expenses that you have, is there extra income from the property business, or is it rolled up? And then she has to take a dividend for that to live off. So it is a very good opportunity to restructure. Maybe it is about creating a whole new portfolio. I mean, there's no tax to pay, so that again makes it easy for us to start from scratch. Currency would be a risk to the client, let's say. In their mind's eye, they think in Swiss francs, or maybe they think in euros, but now they need sterling. And so do we need UK corporate bonds? Do we buy UK equities? Under the old res non dom regime, that would never come up, but now you can. It doesn't mean you do, but that is an option. And that generally, for a non-UK person, that is a brand new asset class. To even consider buying those types of assets. So that's something that we do. And I mean, thanks to Lisa, they've got the advice when they've left. The issue for us is that 4 years is very quick. Yeah. I mean, our time horizon is 10 years when we're looking at buying any asset at all within a portfolio. And it could be that we start on day one with a restructure, but what happens in year 4? Are they going to stay? So then do they need those UK assets if we bought them? Or are they going to move back to France or back to Switzerland? What currency exposure did we have? And have we had to hedge back to Swiss francs? Because that's the key reference for the client.
And just talk to us a little bit about Lombard lending as a concept. There's a portfolio here, there's European property that might need liquidity. And so how could she lend against the liquid assets that she has in an effective way, if required, as part of this review of, as you say, looking at her expenses, costs, what that asset base has got to deliver?
Well, it'd probably be determined by what the loan is for. If it's to buy a property, for instance, well, then you could have a Lombard loan against the liquid assets. But that might create a need for restructuring to take less risk within the portfolio. Maybe have more bonds. But if that is a UK property, go back to, should that be UK fixed income? Or do you stay in euro fixed income and then you take that currency risk to service the loan? That would also be a faster route for the lending. I mean, we don't do UK mortgages or French mortgages. That's a local banking proposition. Speed is also a nice side to a Lombard loan because they're normally very fast. But the key part would be the asset allocation of the portfolio, so the client doesn't have any issues after they've drawn the loan.
And as we mentioned, the vineyard, it's illiquid in nature. The cash flow is not consistent. How would you be looking at the overall portfolio with that in mind, or the illiquidity of the rest of a portfolio in a property business and elsewhere?
I mean, clearly they're real estate heavy. I don't think we know if it's commercial or residential, but there's fixed property there. So when it comes to asset management, we can see the whole picture, and hopefully the client tells us everything. We can exclude maybe real estate investments through listed vehicles. Maybe we reduce or exclude French assets to a property, just to mitigate any of that home bias risk to that portfolio of assets. And we do that on a daily basis.
And what do you think the key benefits are to Francine retaining asset management here in Switzerland when she moves to the UK? What does it offer her from the industry here in Switzerland?
I mean, I think for Francine moving, I think it's because potentially it's a short period of time. You wouldn't be changing your banking. If she has her portfolios here, why change that if potentially you're already leaving after 4 years to maybe go back to Switzerland or to a third country? Switzerland having the bilateral agreements in place with every country in Europe, it doesn't really matter where you live, but your assets can be held in an extremely stable environment. Your bank account won't be closed because you move to the UK, which is a good thing, of course. And if you go on to a third country.
Like Italy, for example, I mean, there's got a very favourable regime. I'm sure we're going to see that kind of move, and Switzerland's well placed for any country, but you know, Italy particularly.
I mean, Lisa will have seen this. The mobility has probably never been higher amongst these clients who are thinking of where to go. And maybe the first country you decide to move to isn't the last country. So actually having the largest offshore booking centre in the world where your assets are kept, at least it would save an administration headache that you don't need to open up new bank accounts.
Yeah, and fosters a long-term relationship because to get to understand the client's risk profile, all the asset base.
Yeah, exactly. I mean,
it's trust and confidence.
We are here to make our clients' lives easier. And if we can do that by just staying put with the assets and the relationships that they have, well, it's only going to be beneficial for them.
And just to close, as Matt noted, Lisa, there's lots of clients looking at mobility in between different countries.
Yeah.
What's your top tip for those customers in general who are looking at making a move, but in relevant to Francine's situation here, thinking about the UK? What are the things you table with her as a top thing to discuss?
So, I mean, I would say one common misconception is that your assets get rebased when you move, and from when you move into a country, that's going to be where your assets come up to. And in the first 4 years in the UK regime, Francine wouldn't need to worry about that. But that's something we would certainly look at, is making sure you don't bring a whole load of historic gain with you into the UK. But generally, we try and keep things as flexible as possible. So no regret moves, brilliant. But don't go into structures that might not work for you so well. So for Francine, though, in a European context, maybe something like an offshore bond would work. You don't necessarily need it with the FIG regime. The FIG regime is already exempting your foreign income and gains, but it can be moved around within Europe. But if, for example, Francine decides to go to, I don't know, Australia, I've got no idea how Australia taxes one of those. And we'd want to check that she could get back out again if that was where she ended up without triggering tax. So it's all about trying to maintain flexibility and not going too far down one route for one jurisdiction in particular. And all the basics: who owns the assets, where are they being looked after, where are decisions being made, all of those things. The more clarity there is, the easier it is to plan whenever you move.
Fantastic. And Matt, what would your top tip be for Francine? What would your advice be as she's thinking about this kind of move?
Well, from the liquid side, it would be how much does she need to live on? And what needs to be generated from the portfolio to keep that lifestyle that she's used to. Because we don't know what she generates from the property business or if that will ever be sold. So that would be the first part. The currency, again, is a big driver. What do you live on? Do you have mortgage to pay? Do you have rent to pay? All of these things are probably going to be quite expensive. And then the time frame. Again, it's difficult to build a portfolio for 4 years, but actually you have to say, well, look, wherever you live in the world, you're going to buy things that are good investments. They're going to be held for 10 years, and we can worry about the currency fluctuations on an ongoing basis. But we have to try and stretch that out. Look at the risk profile of the client and who's going to benefit from these assets. Is it Francine or is it the daughter?
Fantastic. Well, look, great to talk to you today. We look forward to sharing this content.
Thank you very much.
Thanks, David.